Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. What is better for an income investor? Selling options like the wheel strategy or dividends? I consider myself to be an income investor. I have some smaller dividend yielding companies, but they grow their dividend at a fast rate. And I have some higher yielding companies like MLPs that pay out a lot more. And I sell puts for premium. So I want to talk about how they're different and if one is better than the other. You have the wheel strategy, which is selling a put and hoping that the put does not get assigned, but in the case it does get assigned, then you turn around and you sell covered calls against it until it gets called away, and you keep repeating in that cycle. Or buying shares in a dividend paying company, reinvesting those dividends, and holding for the long term. So we're going to compare selling options and dividends in 4 different categories. One is how much money it takes. Next is the learning curve. Next, how much time it takes to actually do it. And the fourth one will be the returns, how much income you actually get from this strategy. Before we do that though, if you're new to the channel, I'm Justin and I like to talk about dividend investing, selling options for income, financial independence, and document my own journey towards financial independence. And if you're new to the channel, I'd really appreciate a like and subscribe to the channel if you haven't, alright? First off, I want to say that selling the wheel strategy has become a lot more popular on YouTube. And it's completely not necessary to become, it's completely not necessary to sell options to become, financially independent or build wealth. Buying index funds, dividend paying companies, dollar cost averaging, reinvesting those dividends and holding for the long term, that works, and that's proven to work, and you'll do just fine doing that. After 20, 30 years, you'll be just fine. You've made plenty of money to retire if you follow those basic ideas of diversification, dollar cost averaging, reinvesting dividends, holding for the long term. And statistically, you'll probably be better off just buying the S&P 500 and reinvesting those dividends and following that approach for 20 or 30 years. So as dividend investors, what we do is we buy shares in dividend paying companies. The companies, they make a profit and they distribute that profit back to the shareholders, which is us, in the form of a dividend. And as time goes on, the dividends should increase because the company is growing and wants to increase profitability. So their profits go up and then they return more money to our shareholders. And what we should be doing is reinvesting those dividends back into more shares and then continue to buy more shares as time goes on. So our dividends keep growing and growing over the years. As option sellers, and I specifically say option sellers, not option traders or option investors, specifically selling options for premium. We make a promise that if the stock goes above or below a certain price within a certain time, that we will buy or sell the shares depending if it's a put or a call. And then we get a fee for that, and that's our income. In the hopes that if we're betting that the shares don't go down, we don't want the shares to go down, so we keep the income and we don't have to buy those shares. It's like insurance. And there's 2 forms of options. There's a put, and we are betting that, or a put essentially is that if the shares go below a certain price within a certain time, that we'll be able to buy those shares for the strike price. Now there's 2 main options. There's a put and a call. And a put is a promise to buy shares if the stock goes down. And a call is a promise to sell shares if the stock goes up. For a put, we need money set aside to buy the shares if it's needed. For a call, we usually have the 100 shares set aside already, and we promise to sell those shares if the stock goes up a lot. The first category that we're going to compare these to is capital required. One thing that's really important that we need to remember about selling puts or calls is that all contracts, they're listed in single shares, but every contract is actually 100 shares. So if you want to sell a put with a strike price of $65, you're going to need 65 times 100, which would be $6,500 set aside in case that you do need to buy those shares and they do get assigned to you. And if you want to sell a call, you're going to need, at least about $6,000 in those shares to sell that covered call. So that's just one contract. And if you want to be diversified, you're going to need a few different contracts. Imagine that you want to sell 5 different underlying positions, 5 different stocks, and each one selling about $30, strike price of $30. That's going to cost you $15,000 to be selling options on, 5 with a bit of diversification. Another problem we have with diversification is if we wanted to sell puts or calls on the S&P 500. The S&P 500 is trading at over $300 right now, and it would cost us over $30,000 to sell a put on SPY. But there are some sector ETFs that do have lower strike prices. With dividend investing, it takes a lot less money to get started. With fractional shares on Robinhood and M1 Finance, you can get started investing with like $5 or $10. You can buy something like AT&T, which is trading at $29 right now, and that has a 7% yield. And you can also buy a dividend ETF like SPHD that holds a whole bunch of different dividend-paying companies that has a 5% yield, and that's trading for $33 right now. So it takes a lot less capital to get started dividend investing. Dividend investing is super easy to get started, and it's almost dummy proof. Almost all retirement accounts have some sort of dividend income based fund in there. And then there's plenty of dividend ETFs that offer diversification and yield. One of my favorite dividend ETFs, ticker Noble, the ProShares S&P 500 Dividend Aristocrat ETF. This has a yield of 2.3%, has 66 companies in there that have been increasing their dividend for at least 25 years. On the other hand, with options, there's a whole bunch of stuff to learn. There's terminology like in the money, out of the money, strike price. There's math and statistics that you got to understand. There's these profit and loss diagrams, and you got to understand like how this option's going to behave if the stock market goes up or down, or how much time is left in the options contract. There's a lot of stuff that you can learn about options. And you go over to WallStreetBets and you can find a lot of stories about people losing a whole bunch of money because they did not understand how options worked. Now, over the past few years, they have created some ETFs that replicate option strategies, and the big one is QYLD, and this replicates selling covered calls on the NASDAQ 100, the Qs. I made a video about that, and I'll link it up here for you. It has 11% yield, but from inception, the price has just kind of been in a downtrend, and these aren't really proven products yet. Learning about options in the beginning can be very daunting and intimidating. And With dividend investing, it's pretty simple. It's pretty simple to get started with dividend investing, and you really don't need to know too much about it, especially with a good ETF like Noble. Next, how much time is required? Dividend investing is like the truest form of passive income. Once you buy those shares, you literally have to do nothing to get paid. You put your money in, you set up you can do it all automatically. You can set up your account, fund it automatically, set your drip on, reinvesting dividends. You don't have to do anything for years and years. You don't even have to look at your account for like a decade if you really don't want to. Maybe your taxes stuff, you have to download your taxes at the end of the year. Don't even have to do that if it's in a Roth IRA or a retirement account. But options are different. You do have to figure out what stock that you want to sell the options on. You have to kind of look at it, figure out how much you want to sell out of the money, how volatile it is. You want to check on if there is an earnings announcement coming up, because stocks behave much differently with an earnings announcement. And a lot of people don't sell options, something like they don't sell puts when there's an earnings announcement coming up. You got to watch your account as well to check on the underlying price performance, whether this stock is going up or down, or if it's in the money or out of the money. If you're at risk of this stock being assigned to you, do you want to take hold of it, or do you want to roll your contract, buy to close, or what you want to do? You don't have to sit in front of your computer all day, but you do have to check in regularly, like on a daily basis, to watch your positions. Finally, we have returns. And we're not going to talk about price appreciation with dividend investing, because we all know it's there and we know it's really important, but we're just talking about it from an income-based perspective, and that price appreciation is, icing on the cake. We want to keep this simple and just compare the dividends to the option premium. Now, you have a few choices when investing in dividends. You can invest in something with a high yield like AT&T that has a 7% yield but doesn't really raise that dividend very much. You can invest in something like Starbucks that has a lower yield of 1.9% but increases it much faster at 22% a year. Or something in the middle like Coca-Cola with a 3.2% yield and increasing that dividend by about 5% a year. These yields aren't too impressive, but after 15 or 20 or 30 years of increasing those dividends, you're going to be rich. You could also invest in the dividend ETFs. And if you take Noble, for example, and look at their dividend history, all the companies pay increasing dividends and they never lower their dividends. But ETF dividends are a bit inconsistent. The ETF always has to rebalance and buy and sell more shares depending on how many people are buying the ETF. So it's not quite as consistent as the underlying shares. Selling options can make you a lot of income immediately. If you sold puts today on SPY expiring in about a month with about 4% cushion, that means the S&P 500 would have to drop 4% for these shares to be assigned to you. It would earn you 1.7% in 1 month, and that's about 20% annualized. About 20% annualized in income if you repeated this strategy and it was successful for you for the full year. And that's a whole lot more money than, your 3% yield from Coca-Cola. But with these bigger rewards come bigger risks, and the more chance that you'll be assigned shares, and that's where you will lose money on a strategy like this. You can choose your strike price and how much risk and how much time you want involved too. So you have a lot more control in how much income and risk you take with selling options. So the verdict is, we know that dividend investing works. We have Warren Buffett and Jack Bogle and all the stuff saying buy dividend paying companies or index funds, which will have some dividend paying companies in there, reinvesting those dividends, dollar cost averaging for the long term. That will work. That's just true, and that's a fact. After about 30 years, you're gonna have a whole bunch of money, and it's gonna work out well for you. Options, on the other hand, there's a lot of misconceptions about options, that people think they're home run kind of things. But options should be sold for premium, and instead of home runs, steady, consistent singles. That's the key with selling options. So there's no real final verdict. It's kind of up to you on what you want to do, as long as you are making an informed decision and you understand the risks involved. But I think that's all I got for this video. I hope you got some valuable information and you thought it was helpful. Leave a comment down below if you prefer selling the wheel strategy or you like dividend paying companies. And then until I make the next video, you can watch these videos over here. That'll be really cool. And I will see you in the next video. Okay? And have a good day, all right?